Hi, this is Jeffrey from Graph Financials. So let's look at the latest quarter of Wells Fargo so we have a sense of what's going on there. So broad brush, what's going on quarter over quarter? Consumer and banking and lending is flat. Okay, commercial banking loans are up 2%. Corporate and investment banking down 1%. Wealth management down 1%. Deposits are down 3%, and both on commercial and consumer lending. So there is leakage of deposits. We're not at a point where it's a problem, and we'll explain why. The ratio of Tier 1 ratio here, CET1, is climbing. So we're not at a point where we are unreserved banking whatsoever. Return on equity is climbing too. Now let's look at net interest income. Was down. Non-interest expense was up sizably. Charge-off, we have an increase in charge-off, and we have a substantial increase in allowance for credit losses. So the provisions have increased sizably quarter over quarter. Non-interest expense down, which is quite interesting. So what we have overall, loans flat, okay, quarter over quarter. Deposit down 2% overall, assets down 1%. Now, we have a very interesting point here. Net interest margin are still up, but they're not climbing like they did, year over year. There was a big, 2022 was a big increase in margin, big mark-to-market losses on long duration assets, but the net interest margin is still climbing. So we're not at the top. Probably the second quarter will be the top, but we're not there yet. So looking at the segments, if we look at the operating segments, consumer and small business lending is down. So that's very important because that means we have probably the small businesses are responsible for most of the employment. So if it's down, how is the economy going to grow? That's raising quite a few questions. So and then you have the actual consumer lending, which is home lending is up. It was down year over year a lot, but since the fourth quarter is up. So that's something notable, quite notable on what's going on with home lending. Credit card is down, and auto is down sizably. Okay. Lower deposit balance. Deposit-related fees decline, reflecting the elimination of non-sufficient fund fees. We don't like that. It's kind of incentive, start to bring some incentive to keep the deposits. That smells like that. Auto loan down. That's where they have they are increasing the allowance for losses in charge-off in credit card and auto. So overall, we don't like very much the situation on the small business lending. It's no good. It's not increasing. And if it's not increasing, how is it going to be resulting into growth? Because that's where the economy and the bulk of the employment is. All right. This is the commercial banking. This is to private, family-owned, and certain public companies. So this is growing, okay? Middle market banking. And also the asset-backed lending and leasing. So probably because the asset value with inflation keeps increasing. Now, small business shrinking, middle market okay. That means the bottom of the economy is, of the small businesses is suffering more than the middle market companies. All right, so that's what we can say. Let's see if we have other things which are. This is the corporate and investment banking. This is smaller in size. Lending is growing, and that's very interesting because lending is growing there while it's shrinking in small businesses. So it's a mixed picture here. We would like to see everyone growing. So we start to see a bit of a juncture, we're at a juncture where not looking good for small businesses. Mid and large businesses okay, but the small business situation is not great. All right, so that's it. We need to review a lot of different quarters to have a better picture. So we're not going to get into too much details on this particular bank. That's not the objective. Thank you very much. Bye bye.